Index heavyweights eke out some gains, but the mid-caps feel the pressure with declines outnumbering advances. Utilities, FMCG and IT are gaining, while healthcare and energy are the big drags.
Dr. Reddy's misses expectations on profitability as US sales dip on lower Revlimid sales and on rising competition in key drugs. But India sales perk up, driven by the Sanofi vaccine.
JSW Group's Parth Jindal tells CNBC-TV18 they are keen on buying Akzo Nobel's India paints business and have put in a bid. He also refutes claims of a cement cartel, saying that prices have been reined in to aid consolidation.
There seems no respite for lenders offering small ticket loans, with Spandana Spurti seeing a shocking surge in bad loans. Suryodaya Small Finance Bank sharply trimming its growth and asset quality guidance, and Ujjivan Small Finance Bank too seeing the pressure in its numbers. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Hormas Fatakia. It's the mid-cap index which has seen a bit of recovery from the lows, the only index in the red right now. Otherwise, it's a stellar day for bulls. Why do I say that? Because for the fourth trading session, we've actually seen a recovery from the lows, and the Nifty today has conquered the 23,300 mark as well, telling you that yesterday's up move was only subdued because of the weekly options expiry pressures. The market was springing to go higher. It has. The Nifty Bank is doing well. The Nifty IT index is doing well. So it looks good, Hormas.
It looks good indeed. You said that the index is on that springboard. It's just about to take that jump, right, to move towards higher levels. And that high of this week, which has been 23,426, is 100 points away now from those levels. We are at the highest point of the day. So it's good going for the index. The bulls want to end the week on a high. The broader markets too have recovered from the lows of the day. And of course, the surge is being led by a lot of these mid-cap IT names. They're the ones that are recovering from the lows, be it the likes of Emphasis and also some of the others that provided cushion in yesterday's trading session as well, and they are doing so in today's session as well. But there are a lot of other earnings reactions as well that we are reacting to this afternoon, and Dr. Reddy's is one of them, and it had its third quarter results, to which it is not reacting too well, with it margins having a contraction in this quarter as well. The profits too were a miss on expectations. Vinny is joining in with all the details on that. Vinny.
Absolutely. So we're seeing a miss that's come on the profitability front. Revenue was in line with expectations. But in terms of revenue specifically, let's just pull up the US revenue, because that's where the pressure came in. On a sequential basis, we saw a decline of around 10% for North America sales. And this was mainly due to the lower Revlimid sales, the generic Revlimid. Now, this drug, yes, we know that this is going to start seeing reducing sales. The patent expiry is going to be coming in. But that is a main reason that we're seeing an impact coming in on the US sales. India business also, when you look at it, what was supporting the growth was the Sanofi vaccine deal that has taken place, as well as the JV with Nestle is something that is supporting the growth in the India business. But on the flip side, we've seen some therapies which were not doing well for Dr. Reddy's, and that was a bit of a blip on that front for Dr. Reddy's in terms of the domestic side of the business. Now, management said that they continue and want to maintain the 25% margin guidance that they've given for the medium-term outlook. Right now, the margins were at 27%, but they expect this to be in the range of 25%. They're going to be focusing more on the consumer care business, biologics, as well as innovations, which will be the key pillars for the company going forward. Research and development expenses and spends would be in the range of 8 to 9% going forward in terms of the range. And GLP-1 opportunities, especially in Canada, India, as well as Brazil, will start coming in from 2026 when the launches are expected to come in. So FY26 end to 27 beginning is when we could see some benefits there. On the back of this, HSBC has maintained a hold rating for the company, target price of 1,250 rupees per share. They're highlighting the semaglutide, that's a GLP-1 opportunity, which is something that is good for the company going forward. And also they believe that the growth for semaglutide is something that they see is a huge opportunity. Citi maintaining the sell call rating and a target price of 1,100 rupees, and CLSA also continues to maintain its underperform rating with a target price of 1,120 rupees per share.
All right, Vinny, thanks a lot for that. But the stock on our radar right now, seeing the biggest crash, is Cyient. Yesterday, the mid-cap IT stocks were doing well today in yesterday's session. But today, we have Cyient, which is down almost 17, 18%, 19% now as we speak, on the back of a weak quarter as CEO Karthikeyan Natarajan steps down. Rima joins in with more details on that one. Rima.
Well, it's quite a crunching blow on the stock today. Two reasons for that. One, the guidance cut on revenues and margins. And two, as you said, the CEO stepping down. So first now for FY25, the company is anticipating revenues to decline by 2.7% for the full year. And this implies that in Q4, revenues will be down by nearly about 0.7%. Margin guidance too has come down from 16% to 13.5% on the back of aggressive wage hikes. And the second reason is the CEO, Karthikeyan Natarajan, has stepped down effective immediately. He steps down after 20 months of being in that post versus his term of 36 months. So brokerages are disappointed. JP Morgan downgrades the stock to a neutral, though they do admit valuations are now cheap. So therefore, according to them, post the significant correction that we're seeing today, don't expect too much by way of a downside in the stock because of the valuations being relatively inexpensive now. The catalyst for the stock will be the new CEO. The bull case on Cyient is 2,300, though for now the target price as a base case is down to 1,750. Kotak says it's another disappointing quarter and therefore they've downgraded the stock to a reduce. But that said, there were a few positives in the numbers. One, the company in the conference call sort of indicated that the guidance is the worst case scenario. It may not be as bad, so the guidance is conservative. The company did see record deal wins in Q3 and they do expect recovery from Q1 given the strong deal wins. So IFL, on the other hand, has a buy rating, as an add rating on the stock. One, because of the expected recovery, and two, inexpensive valuations. That said, the risk, according to IFL, is that the ramp-ups, because they have a strong deal pipeline, but if the ramp-ups get delayed, then perhaps this recovery thesis gets challenged. Back to you.
Indeed, and it's one of those stocks, right, where below par earnings or some management change has resulted in an extreme reaction, as has been the case for a better part of the last 2 quarters as well, and 19.5% crash.
Just a word on the mid-cap IT space itself. It's been very interesting because day before yesterday, Persistent was down ahead of its numbers and in a fair amount as well. The numbers weren't as disappointing, and then yesterday we had this wave of buying in all the mid-cap IT stocks, and as a result of which we saw even Cyient being extremely bid up ahead of its numbers. Now the numbers have disappointed. Persistent has moved to the high point of trade. Decent numbers coming in out there, especially as against the Street's positioning. And then Cyient, post-Street's positioning, the double whammy that Rima just spoke about, down 20-odd%. So it's been, positioning plus the actual results, which have actually exaggerated those moves.
Indeed, it's a 20% crash on Cyient, but on the other hand, stocks like Coforge and Persistent Systems continue to get bid very well. Persistent too has recovered from the lows of the day today as well after that positive commentary from Emphasis. Time to take a short break, but before we do that, it's time for Growth Code, which is a special initiative by Grow and CNBC-TV18, which is designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll try and demystify the gap between retail and institutional players when it comes to accessing algo trading.
एल्गो ट्रेडिंग नहीं एल्गो ट्रेडिंग तो सिर्फ बड़ी कंपनीज को फायदा देते हैं.
It's like a rocket science.
नहीं, ये सब मुझे समझ नहीं आता.
मुझे तो हमेशा लॉस ही हुआ है.
By the time I set up my algo, the market has already moved on.
Algo trading has long been dominated by institutional traders. In financial year 2024, 96% of proprietary traders used algos, compared to just 13% of individual traders. The results? Institutions made 32,000 crore rupees in profits, while retail traders lost rupees 1.8 lakh crore.
It is not necessary. In algo trading, you will be always a profitable trader. So this is pure myth. If institutions are using algorithm because they have a wide experience, they have wide data, they have different type of study material, which single person cannot go with.
Recently, SEBI proposed a set of rules that can open up safer and more transparent algo for all.
SEBI is particularly very keen with the unsolicited claimants who are claiming that they are giving the fixed rate of interest through algo trading. It should be in a very regulated manner.
For retail traders, the game is still challenging. But the new guidelines can help set better rules for a fairer chance ahead.
Welcome back. Closer to 23,300 for the Nifty. It's been a good recovery, so perfect time to get you all the updates coming in from the F&O space, especially given next week is the expiry week, and immediately post-expiry we will have the budget as well. So all these factors into place. Indices are off lows today. The Nifty bank is supporting The Nifty IT index is supporting as well. And earlier, remember, we were pointing out how the Nifty has been making lower highs. But last 4 trading sessions, the Nifty has actually been making higher lows. And does that indicate a trend change or not is something we'll keep an eye out on. Typically, the broader market tells you the sentiment of what, the frontline index is going to do. We've seen the midcap index underperform. It's recovered a little bit. So is the low of the market protected or not is something we'll have to, navigate through and keep an eye out on. For the very near future, the 23,300 call has been extremely active. The level where the Nifty is right now facing some supply as well. Premium for the next week is close to 200 rupees. Remember, as we progress towards the budget, the India VIX will increase, and that explains why the premiums on these indices, index options are higher. And 23,000 put is also equally active. So 22,950 is the support, and 23,400 to 23,500 is the supply zone as per what the options are saying. So we'll keep an eye out on this. And NMDC is the stock that I'm watching out for. Second day running, a lot of open interest build up. Can it enter the FNO ban or not is the big question. But, Hormaz, the big point is after making higher lows, are we out of the woods for the market or not? And I guess, our next guest would be an appropriate person to comment on that.
Oh yes, Manish Hathiramani of Deen Dayal Investments is joining us to answer that question. Manish, good afternoon. Thank you for joining in. You heard the question that Mangalam just posed. Are we out of the woods on the chart patterns that we are currently making on the index? But are you still working with the range as has been the case over the last 2 weeks? And couple that up with your stock recommendations as well.
Good afternoon, Hormuz, Mangalam, and all to all our viewers. Thank you so much for having me. Well, I still feel that we are really holding on to a short-term support of 22,950 to 23,000. Having said that, in my humble opinion, this is a very, very fragile support. And the reason why I say that is that if we trigger that even minutely, we can fall all the way down to 22,500, 22,600 levels. Resistance on the upside is currently capped at 23,600, 23,700 levels.
All right. And is there any mark that you're looking at before initiating a trade, or this is a no trade zone as per you?
As of now, we are in no trade zone. I would be very, very cautious until we don't really get past the levels of 23,500. We won't even review the upside. On the downside, this 22,950, 23,000 continues to be a solid support.
And what about specific stocks, Manish?
Well, since I still feel we are bearish, we're not out of the woods, I'm working with 2 sell calls. The first one is on a Reliance, which is for a target of 1210, stop loss of 1305. We resisted at the 1300 levels on the 17th of January, and thereafter the stock was unable to hold that price point. We then broke the supports of 1275 on the back of good volumes, and then thereafter Reliance has turned down. The second one is on Tata Motors, which is for a target of 715, stop loss of 760. This stock had recovered from the lows, but we faced stiff resistance around the 800 levels and again triggered on the sell side. We are also seeing high volume spurts on the falls, which is further determining the weakness.
All right, we take that point, Manish. Thank you so much for joining in and giving us your views on the market and a lot of individual stocks. With that, we'll take a short break. On the other side, we have the management of Greaves Cotton joining in to discuss their quarter gone by, the outlook for the year going ahead.
Welcome back. Now, Greaves Cotton is the first management on the show, and it was a good quarter for the company. The profit surged over 64%, while the margins, though, were flat. And we have Akhila Balchandar, who is the CFO at Greaves Cotton, who is joining in to discuss the road ahead for the company as to what lies ahead for it. Akhila, good afternoon. Thank you so much for joining in. Take us through the quarter gone by. Your engineering business revenues were up 14%. On the top line front, you've done fairly okay. Your profits were also up, but the margins were flat at around 5%. Do you see them improving in the current quarter, which is the fourth one, or do you see an improvement coming in FY26?
Thank you and for taking me on the show, and a very good afternoon. We've reported a very healthy quarter. For the quarter, GCL, we had a standalone revenue of 500 crores, up by 13%. 9-month consolidated, we have reported 2,096 crores, which is again a fairly good achievement of ours. On the margins, GCL plus Excel, the company we acquired in May 23, we have reported a healthy margin of 14.4%. We are lower compared to Q3 last year.
Akhila, sorry to butt you in. Sorry to cut you in. We have the numbers with us. I was just asking you about the margin picture. You know, the 5.5% margins that you reported this time around. Do you see them improving in the ongoing quarter, which is the fourth quarter, or do you see them improving in FY26?
Yes, that's exactly what I'm trying to say. If you see our journey over the last few years, we have been reporting margins at the, this is GCL plus Excel. Consolidated, our numbers have been flat, but at the standalone company, our margins have been improving, and we are in the range of 13 to 15%, which is what I have mentioned in the past, and we continue in that journey at 14.4%.
All right, that's about the standalone business. But, you know, everyone is excited about the value proposition in the e-mobility business. While they're excited about it, there is also this concern with regards to competition out there. You know, when you guys started selling your EV two-wheelers, three-wheelers, mostly two-wheelers, y'all were doing extremely well in that segment. One wants to know what the market share is right now, given the larger players have come by as well. You have, you know, the likes of Bajaj, TVS, Ola, all of them saying that they are gaining market share. At what cost? I mean, are they gaining it from ICEs? Are they gaining from people like you? What was your market share earlier? What is it now? If you can comment on that. And at the same time, give us a path to profitability for your EV business.
Sure, I'll put few points. But as you know, we have filed for the IPO and the DRHP. So I will be limited in my comments. In terms of December, we have actually increased our market share given the new launches that we have done, the NXG and the Magnum Neo. And we believe that basis these new product launches and a couple of more products that are in the pipeline, we are good to regain our past glories.
Could you give us numbers of where does the market share stand at? What was the past glory? What was the dip?
So if you remember in Q4 of FY23, we were at an 11% market share. And given the FAME subsidy matters over the last year, we've had our challenges. Currently, with all that behind us and the new product launches, I think we are set up for a robust future.
What is it now? What is the market share now? Akhila, what exactly is the market share right now?
So in December, we were at 4% market share.
Got it.
Yeah.
So 11% has fallen to 4%. You believe that it will continue to grow higher from here on. And the path to profitability and the timeline for the IPO of the same, you said you've filed papers. If you could give us a sense on by when can, you know, the street expect the IPO to hit the road?
Sure. So we've filed the papers and the response from SEBI is expected. So I will be able to come back to you at an appropriate time on that.
You know, the e-mobility business as of now for the consolidated entity is around about a quarter of your overall business. Do you see that share, the mix improving as we go ahead, as the mobility business grows as well? Do you see that reaching upwards of 25 or 30% sometime by FY26 or say 27?
I would like to mention that, you know, we have gone on our diversification journey from a single product, single fuel to multi-fuel, fuel agnostic, and diversified our revenue streams. The endeavor is to ensure that we are not reliant on any single source of revenue, and we have a highly diversified revenue stream. I think we've done well on this journey, and that is where we are on the path forward.
As of now, what exactly is the holding company's shares or shareholding in the EV business? And what is your dilution during the IPO likely to be in a range? We're not asking for specifics because you're obviously not able to answer that legally. But if you could give us just a rough range for the street to understand.
As I said, the IPO process is underway, and we will be able to come back with more details at an appropriate time once all the regulatory approvals and processes are received by us.
But it is mostly likely to be an OFS itself, right? Or you are looking at some fresh capital too?
Well, all the details are in the DRHP, and there is definitely fresh capital to be introduced into the company.
Clubbing two questions into one, Akhila. One was about the energy solutions business, which grew about 20% on a sequential basis. Do you see that level sustaining? And the other one being Excel, where exports were about 28% of the contribution. Do you see that sustaining as well? Or do you see a normal range that you're working with over the next 12 months?
Exports is one of the focus areas of the company. Currently, our overall contribution of exports to the revenues is less than 10%, and we would aim to grow to around 20% plus over the period of time. Excel, 28 to 35% has been the range of exports over the last few years, and that is something we are very focused on continuing.
All right, and final question then for FY26 on a consolidated basis, what is the kind of revenue projection that you have given all your diversification plans and the plans of looking at improving your operational performance too? So roughly, what are the kind of margin bands that we should look at and revenue growth prospects for FY26 on a consolidated basis?
Well, I will not be able to give forward-looking guidance, but if you take our history over the last 8-10 quarters, GCL plus Excel, we have maintained margins in the range of 13 to 15%. And given the various initiatives that we are undertaking, I think that is a range we would target to maintain and grow onwards.
And e-mobility, when does that become profitable? What's the path there?
Being a IPO, the DRHP, I think legally I will not be able to comment beyond at this point in time.
All right, Akhila, thank you so much for sparing time joining us today. Wish you good luck for the road ahead and, of course, for the upcoming IPO as well. The management there of Greaves Cotton on the road ahead. Time for a short break. Up next, we focus on our special segment, Quarter Se Quarter Tak, to decode what to expect from the auto sector in the current quarter. Stay tuned.
Moments ago, we spoke with the management of Greaves Cotton, but that was just one of the auto companies or auto-related companies that reported numbers. What is the street expecting from the entire auto pack this time around? This is our special Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. And let's drive across to Sudarshan, who will tell us what one is expecting from the auto sector. Sudarshan.
So the BSE Auto Index underperformed the Sensex by 600 basis points in Q3 FY25, and this comes after a continued outperformance over last 3 years. And despite hopes for a stronger post-festive recovery, demand across key segments fell short of expectations, leaving the industry grappling with several challenges. Seasonal pressures, including heightened discounts and weaker product mix, compounded these issues. However, stabilizing commodity prices provided some relief. Talking first about two-wheelers, the two-wheeler segment is likely to deliver a subdued performance in Q3 with wholesale volumes remaining largely flat year-on-year. Adverse changes in product mix are expected to impact average selling prices negatively, with a sequential decline of up to 1%, that is the projection. And margins are also likely to contract by 50 basis points sequentially, reflecting the pressure on profitability. For four-wheelers, it's a tale of mixed trends. Performance is likely to vary across key players. Mahindra & Mahindra led the pack with 20% year-on-year growth in auto volumes, followed by Maruti Suzuki at 13%. But Tata Motors reported flat domestic dispatches, while Hyundai's volumes declined 5%. The broader market remains weak with elevated inventory levels and rising discounts, signaling underlying demand concerns. However, for commercial vehicles, a higher share of medium and heavy commercial vehicles is expected to drive average selling price improvement and margin gains. Amongst four-wheelers, tractor demand stood out as a clear positive, with hoses rebounding strongly, and that is up 18% year-on-year. This growth reflects robust rural demand and improved agricultural sentiment. Tractor makers like M&M and Escorts are expected to report improvement in margins sequentially. For ancillary companies, ancillary players' outperformance may continue. Revenue growth for ancillary companies is projected at 16% YOY in Q3 versus 11% anticipated for OEMs. Premiumization trends and higher content per vehicle are driving robust performance for players like Samvardhana Motherson and Uno Minda, and both are expected to deliver double-digit revenue growth. The tire segment, after facing multiple headwinds, is likely to bottom out in Q3. Stabilizing rubber prices and potential price hikes could boost margins, providing a tailwind for tire manufacturers. Talking about valuations, most stocks over the last few months have fallen in the range of 30 to 40%. But if you look at valuations, most stocks except Maruti are still trading near to or higher than the 5-year average. In two-wheelers, TVS Motor remains the most expensive stock, followed by Eicher and Bajaj Auto. In the four-wheelers, M&M has narrowed the gap with Maruti, and now both companies are trading at a similar valuation. And talking about the valuation for the tire sectors, it's like both Apollo Tires and Balkrishna Industries are trading somewhere near to 5-year average. So overall, Q3 it's going to be a mixed quarter, but more than the earnings, the focus would be on the commentary, what these companies say about Q4 or going forward.
All right, Sudarshan, thank you for that. There's a very detailed expectation of what the auto sector is likely to do in the third quarter. And to take this forward, we are now being joined by Jay Kale, who is the Senior Vice President of Research at Elara Capital, who is joining in on the show. Jay, good afternoon. Thank you for joining in. You know, you're going through your note where you mentioned that you're expecting margins to drop for most of these auto companies this quarter, be it sequentially or on a year-on-year basis. Well, one of the factors you can attribute is to subdued demand, but is there any other factor that you are picking up when it comes to attributing it to this potential margin fall?
Yeah, good afternoon. Yeah, you know, we do have most companies reporting QOQ margin contraction, and the expectation is that with festive season, you normally see the lower end also coming back a little better off. So apart from relatively subdued demand, it is also the mix that will play a role in terms of relatively weaker margins, especially on a QOQ basis, if we have to talk mainly about two-wheelers. In passenger vehicles, of course, mix has been largely stable, but it is different for different companies in terms of how their volumes are. But in passenger vehicles, I think the discounting has been at elevated levels, and hence there could be some bit of QOQ pressure on margins, which normally happens in a Q3 versus Q2. But this time, of course, we have seen reports of discounting being elevated for the passenger vehicle industry, especially.
All right. I had a two-part question for you, Jeff. One was, while most on the street are expecting, some sort of qualitative commentary from the management, what are your own initial assessments of the next couple of quarters? How do you expect demand to grow for the sector? And the second part is, what are your thoughts on this Maruti versus M&M debate? Because the valuation gap is now narrowing, with M&M having the additional benefit of, rural recovery, perhaps aiding the farm equipment business as well, notwithstanding the weakness that we're seeing in CVs, and the tailwind of their SUV PV business as well. Which one should one bet on?
I think both have their strengths and weaknesses. Of course, if we see, first to your question to your industry growth assumptions, of course, in FY25, we are expecting two-wheeler industry to grow at around 10%. Passenger vehicle will grow at around that 4 to 5%. But we have seen some green shoots in demand in December, mainly led by discounts for passenger vehicle industry. One needs to see how that sustains going forward. To the debate of Maruti versus Mahindra, of course, Mahindra has been growing in strong double digits on the back of new model launches, whereas Maruti will be piggybacking more on the hope of industry growth revival. So I think, if you see Maruti's volume growth in FY25 will be single digits, whereas Mahindra will post close to 18 to 20% volume growth. So I think it's all about, industry growth coming back for Maruti, whereas for Mahindra, I think the sustenance of the new model launches and also the expectation of a strong response for their BEVs, which have been launched recently. That will be keenly watched for Mahindra. We are positive on both the names, Mahindra and Mahindra.
What about Tata Motors, Jay? What are you anticipating this time around? Because there are challenges all around, right? Be it in the CV business, be it for JLR with the issues in China as well. And the stock having almost corrected 35 to 40% from its peak. What do you anticipate for Tata Motors this time around? And do you believe that any adverse expectations of a quarter like a bad quarter is already in the price?
Yeah, absolutely. I think there have been concerns on, I would say, especially on the JLR piece. I think the margin delivery of JLR will be keenly watched this quarter. And also the guidance of JLR for FY25 and FY26. There have been pressures on volumes, especially in China, which is now well known and well understood, and the stock has also reacted partly because of that. But I think one of the key things to watch out in Tata Motors results will be the JLR margin, of course, free cash flow, as well as your guidance for FY25.
What kind of hopes are you pinning on the Creta EV launch, and what are your thoughts on Hyundai?
Yeah, I think, again, Hyundai has a similar kind of triggers like Maruti in terms of, it's mainly betting on the industry growth revival. Which needs to be seen how sustainable the December growth is going forward. Creta EV, of course, the Creta brand is quite strong. So the Creta EV will piggyback on the strong brand value of Creta as a brand. But it's not a born EV as yet, and we need to see how Hyundai launches born EV products going forward. But definitely, Creta brand will aid in the domestic market for the EV as well.
What about tires, Jay? I wanted to shift focus a bit from the auto companies to the tire names. There were reports of price hikes that these companies have undertaken, but are these price hikes enough to offset the rise in rubber prices, or do you expect some margin pressure for these tire companies as well this time around?
Yeah, absolutely. I mean, of course, we have seen price hikes and pricing power, and the industry has been relatively stable, I would say. But we have seen one tire company already report, right, Cyient, and we've seen that there has been pressure on a quarter-on-quarter margins despite the price increases taken. And the guidance on the RM index going forward also is more of flattish in Q4 versus Q3. So in our view, tire margins will continue to remain under pressure, maybe kind of bottoming out in Q3, but Q4, Q1 will still not see a major increase as what was maybe earlier expected. With Cyient also coming and saying that we are seeing a flattish kind of RM index in Q4 as well, we believe the tire names will remain under pressure.
All right, thank you so much, Jay, for joining in and giving us what a preview into this sector would look like. We request you to join us once the results are announced as well, to give us your immediate analysis on those results and whether they actually meet or beat the expectations that we've set for this time around as well. But with that, we'll step into a short break, and as we do that, let's tell you a little more about the CNBC-TV18 app. Good news for our viewers: the India Business News leader is just a click away. This is the interface of the all-new CNBC-TV18 app, via which you can get instant access to breaking news, in-depth articles, and financial world updates, all of them coming at your fingertips. Now, we've asked you to download this app from either the Apple Store or Google Play Store. If you can't find it still, just put your phone cameras up here, scan this QR code, and you will get the link from which you can download the CNBC TV18 app. And once you do that, again, all the business world updates right at your fingertips.
Extremely choppy are the markets. We started the show with the index at the highs of the day, and we have corrected very swiftly from those levels as well. 100 points almost now down from the day's high. The Nifty is almost back into the red now as we speak, and earnings reactions continue, and Amber Enterprises is one of them. Had a very strong up move in yesterday's session ahead of the numbers and is now reacting to its quarterly earnings. Upasna is joining in to break that down for us. Upasna.
Well, certainly, company has reported a strong set of numbers. It's a beat across the board. Revenue, EBITDA margins, PAT, all three stood above the poll estimates. Now, this strong performance was mainly driven by strong RAC demand in anticipation of positive summer season. Now, let us look at the numbers first. Revenue saw an uptick of 65% on a Y-on-Y basis, while we were estimating a revenue growth of around 33%. Now, EBITDA margins also increased sharply from 6.1% to as high as 7.5%. This increase of 140 bips is mainly driven by the outperformance in the RAC margins. Now, coming to PAT stood at 37 crores versus a loss of 0.5 crores, which was again much above our poll estimate of 23 crores. Now, management held a con call today morning, and the management commentary remains quite upbeat. Now, management says that the consumer durable revenue growth stood at 67%, out of which RAC contributed a growth of 71% and non-RAC saw a growth of nearly about 43% on a Y-on-Y basis. In electronics division, the management has commented that this division is on a transformative growth path and has also increased the revenue guidance for electronic division from 45% to 55% for FY25. Company has also highlighted that it has bagged new orders in the segment of defense and renewable energy for PCBA, and railway and subsystem and defense division, which saw muted growth. The company has commented that this performance was impacted due to delay in Vande Bharat and Metro project, and it expects profit normalization by H2 FY26. And lastly, company has highlighted that the new greenfield facility of Sidwal is expected to commence operations by Q2 FY26. So all in all, good set of numbers and even upbeat management commentary for Amber Enterprises.
Upasna, thanks a lot for that. 3.5% higher is Amber Enterprises still holding on to gains. Take a short break. More on the markets and specific stocks on the other side. Stay tuned. Welcome back. There was some attempted recovery in the broader markets, and that too is now getting very swiftly sold into the midcap index. Is now off the highs, off the attempted highs at least. The 0.7% lower now, another 350 point cut. Cyient continues to be the top laggard within the broader markets, 20% cut after its results, as is Tejas Networks, 8.5% lower there as well, continuing to maintain the losses at the lowest point of the day. And what is bucking the trend though is a stock called Capri Global. That stock is up 13% in today's trading session, along with other mid-cap IT names like First Source Solutions, Emphasis. That recovery in Emphasis has just triggered a very, very sharp recovery in a lot of these mid-cap IT names, be it Persistent, Coforge, or even First Source Solutions. There you can see 7% higher now on First Source, almost 5% on Emphasis, another 2.5% on Persistent. Remember, it was a very, very sharp gainer in yesterday's trading session as well. So mid-cap IT is the one that is bucking the trend in an otherwise weak market, and the index too is off the highs of the day. With that, it's a wrap on this edition of Halftime Report from Manglam, me and the team that put this show together. Thank you so much for watching. Business Lunch for the next 30 minutes.